about something that I touched on briefly in our earlier panel, and that is kind of the idea of robo-advisors and AI algos, and really the technology, the new technology in investing. For that, I want to bring on our markets and quants reporter, Dani Burger. Dani?
Great, thank you all. So I love how Matt in the previous panel described the apps and online things that those millennials are using. I'm happy to have with me 3 experts in this industry, which I promise you are more than just millennials. We have Rogier Minderhout, founder and managing director at myPension, an online pension insurance service using low-cost ETF. We have Erik Podzuweit, founder and co-CEO of Scalable Capital, a digital wealth management service. And finally, Tamaz Georgadze, founder and CEO of Raisin. It's a marketplace for term deposits from banks across Europe and also has an online investment service as well. So not to start everyone off by putting you on the defensive, but on the panel before we heard from Jim Norris, and I'm sorry, Jim, wherever you are, that you can't come up and defend yourself here, but he had said that the startups, the apps, the online services, they're not the future. It's not what the majority of ETFs are going to be traded for, that the real change comes when the existing asset managers adopt these services. Erik, why don't I start with you? Is he wrong or is he right?
He's right, but I think he's wrong in his assessment that this is not happening. It already started happening. I mean, if you look at, maybe I'll take us as an example. Scalable Capital is a digital wealth manager, quite a young company, founded 3.5 years ago. We're live since 2.5 years. We now manage around 1.1 billion of assets. And we partner with big financial institutions. The most prominent example is ING DiBa here in Germany, 3rd biggest bank in Germany, who basically sells us to their client base. And that's, it's not an asset manager, it's a bank, but I think that's what he meant. The big financial institutions, asset managers, brokers, banks, insurance companies, taking this new technology and applying it to their existing customer base. And we can later talk about why they do that. Yeah? Do they solve a problem? Is it real customer demand that demands it? But that's already happening. That's where we see the majority of the growth coming.
And Tamaz, what do you think about that?
So I would disagree. Someone needs to disagree. So I think the change will not come from the traditional industry. The reasons are very simple. First is they have something to lose, and they're notable for dragging out the change. And it's very hard to sell 2 parallel products at different price levels to the customer. I think either you change completely, and that's a dramatic shift actually for those people who have clients' assets, or you stick with the model and try to hold out as long as possible. I think the strategy for the large players have been hold out as long as possible, close your eyes, try to lobby and at the customer's expense. And I think that will linger on. And I think actually the task we have for the society is to appeal to a different set of customers through much more aligned interests than the traditional players have.
And Roger, you're coming into a space where, very fragmented market in Germany in terms of retirement savings. What does it look like for the future there? Does it continue where myPension, a startup, is the big player, or is it the existing forces acquire myPension, or they grow and have their own sorts of services?
Well, an acquisition, we're always willing to speak. No, I'm with Tamaz. We are in the space, private insurance policies, where you have very large companies, Generali, Allianz, etc. Whilst we're offering a product that, with Vanguard portfolios on a life cycle management, actually offers a better investment strategy for people saving for their retirement age at a much lower cost. We're about 60% lower cost on the margin, with a product that is inherently more flexible because it is online. So you really speak about a dominant product against these larger companies, and I don't really see how they can match that. They have these huge infrastructures. You've seen it with banks too, where Deutsche Bank, Commerzbank are in large difficulties and actually trying to decrease their capacity to be able to be competitive in this marketplace. So them actually copying, if you will, our business model seems to me like a very difficult thing to do.
And one thing, so I want to get into sort of the business model a little bit and how you build these investment strategies exactly. So Roger, I know one thing that I think is pretty interesting and that the other panelists might have a different view on is building these, what sort of ETFs you give the clients. How do you decide what sort of ETFs should they get? Do you care about their risk profile? Walk us through that. Yeah, Roger.
Well, we are helping people to save for their retirement age, and the question, how do I save for that, is actually one that has a positive and single answer. Your duration, that means that the amount of time that you have until you actually need the money is in our case 20, 30, even 40 years. And then it's easy because the stock markets over longer time periods always outperform other investment categories. That's not by coincidence, there's also a theoretical background for that. So it's very sensible for a 28-year-old to be, in our case, in 100% stocks. Whilst if it gets to retirement age, when he's 60, 62, the portfolio starts automatically shifting to less volatile ETFs. The question then that is typically asked, how risk averse are you, or how chance oriented you are, as they typically ask in Germany, is a bit of a tough question to ask a 20-year-old who will sit there and say, well, yeah, look, for my retirement, I don't want to be too risky. And then he gets advice into a portfolio that is actually inefficient for him on the long term. So in other words, the only measure that we have when we, in a sense of a robo-advisor, if you want to use that term, is the question, how long do you have until you have the money? And then you get into where the ETFs then get invested in. That is your question. It is a global portfolio weighed by market capitalization worldwide. It's the ultimate passive portfolio. We sometimes say somewhere in the globe is there always a good return which you have in your portfolio, and you decrease the volatility and make a return of historically about 8%. Going forward, it's tough to say, of course, but that is the most sensible thing for people to do. And we do that with 5 Vanguard ETFs actually. Shifting into 2 bond ETFs towards retirement, also from Vanguard.
Right. So what Roger here is saying that, you know, if I am a 28-year-old and I have a penchant for buying 3 times levered inverse oil ETFs, I'll still get put in the same sort of plan as someone who likes buying, you know, the Vanguard S&P 500 market cap. Erik, does that make sense?
No, probably not. But I mean, maybe let me address something which is, I think, at the root of why people like and why there's demand for these robo-services. Yeah? Robo-advice is actually the wrong term because you don't offer advice, it's investment management, because advice, at least directly translated into German, Beratung is you have an advisor, he advises you, but the client has to make the decision, and that's different what the robos actually offer, it's wealth management. You give, it's a fiduciary mandate, someone makes a decision for you, and while this sounds similar, it's a completely different user experience. The major hurdle for people, for retail customers to buy ETFs is selecting the products. The investment strategy is important as well, but the major first hurdle is selecting the investment products. And speaking to professionals, that doesn't sound so fancy, but it's actually a super big hurdle. There are over 2,000 ETFs in Europe. More and more are coming, and conditions change. Yeah? New players introduce different pricings. You have changes in tax laws, and we had a change in the taxation of foreign accumulating funds this year. And this is just too much for an individual investor. And so the first very important building blocks is simply to, out of these 2,000 ETFs, select the right ones. And you can, there's a quantitative and a qualitative catalog that you can go through, costs, and within costs, obviously, I mean, you know that it's not just TER, it's total cost of ownership and tracking errors and numerous aspects of that. But doing that and basically guaranteeing the client that he has whatever, 10 ETFs in his portfolio, and he can be assured that these are the cheapest ones, the most tax-efficient ones for him personally, and that someone has an eye on the market development. Yeah? One ETF gets more liquid, spreads come down, one ETF lowers its prices, one ETF changes his tax treatment, and I don't have to take care of any of that. The robo-manager is doing it for me. I think this is one of the major drivers why people use and should use that service. Yeah.
But still, to Roger's point, I mean, if the end goal is saving, and you want the end user to have their P's and carrots, why adjust with how much risk they can take on? Why not give them something that regardless of what sort of risk profile they have, will be beneficial for them at the end?
I mean, you have to individualize it because, I mean, markets go up and down, yeah? And I don't think that any robo-advisor really claims to have found the holy grail to just deliver returns and no risks. So, but what you can do is save wherever you can, yeah? A couple of basis points here, a couple of basis points there. And basically, I'm coming back what I said before. This is the trick, yeah? To have the most cost-efficient, the most tax-efficient portfolio possible. And that's hardly any investor has it, because you cannot get this in the classic bank advice. It's not possible. You meet once a year, the bank advisor is not even equipped with the right tools, not even with the knowledge to do that. The software can do this 100 times better.
Yeah, Roger, you look like you have something to say to that.
I guess the difference between Scalable and myPension is, in a sense, the investment horizon. If Scalable asks people on a horizon of 1 year, what is the value at risk that you're willing to take, then it is a fair question. But if the question is, if the investment goes over 20 or 30 years, it's not the right question to ask. If you will, the 3 people that are sitting on the stage right now are different in the sense of the duration that they're serving. Our question is, how do I put my money away for 20, 30 years? The Scalable question is, how do I sort of optimize my investment on a horizon of 1 year, maybe call it a midterm?
No, that's not true. Our customers invest for the long term. They don't know yet whether they want to invest for 20 or 30 or just 10 years. Yeah? Main customers, most of our customers' money is coming from cash. When we ask people how long is your investment horizon, they usually do that. Yeah? Might be 20 years, they might need it earlier. That's why it's important that they can invest and de-invest quickly if they want, but usually the investment horizon is quite long. Yeah? We're a young company, but I expect 15 to 25 years.
And Tamaz, I want you to get into this too. I mean, the online marketplace that you serve, the ETF portion of it, where do your users fall in between having a long term versus letting them play around, decide where they wanted to go?
So actually, for that part, we went into a very classical, simplistic approach. So we have just 4 portfolios. There is no customization possible. Lowest cost on the market, so we're 49 bips, including ETF costs, and it's actually for people who decided they want to do something on investing side, but think that the cost is a hurdle. Because if you look at both robos and also actually active solutions with a passive underlying, let's call them that, they would be significantly above 100 basis points. So still much cheaper than 220 basis points was the classical active advisor in the branch would sell to the customer, but far above what is reasonable in the current environment. For us, it's a portion, so we see it a bit differently than a typical robo would see. We're a bit of a different animal because we realize when we acknowledge actually Europeans love bank savings. So out of 15 trillion private wealth, 10 trillion is in bank savings. And we offer the customer both. So we have a very good tool to optimize cash savings and to deliver you last year 5 times the average return in the market. And we give you the investment part as well. So of course we want people to use more of that because on average they are just below their risk tolerance level by far. But we deliver both optimizations out of one hand. So, and we believe that if you make the product more relevant for the masses, you can make it only by addressing actually the pockets where the customers are. So you can try to educate them very, very long, but if you give them first experience telling him, okay, your bank gives you 0.05%, we are actually delivering 1% on average with deposit insurance protection. And if you had a good experience for 1 year, we give you the second part as well. And it's actually the cheapest solution on the market. So that's how we see it. I think to look at only the investing part is a bit dangerous because that's a minor part of the business for the customer on the one side. And then the typical mental mistakes people are making. So if you ask a customer, of course, they will say, oh no, I don't want any risk. So German says, so if you let them choose without guiding, everyone would go into 40% equity, 60% bond. in reality, they're 80% cash. So deciding only on that portion, on the investing portion, would not solve their real issue. So you have to give it both out of one hand.
And so one thing that I think is pretty interesting is you're talking about being this one-stop shop for all these solutions, helping their investment management. What's sort of the business at myPension? I mean, does it make sense to stay a niche company, or do you have future plans of being a one-stop shop for any investment need?
No, we want to be the solution for the retirement savings. Retirement savings is a huge problem in Germany. Out of the taxpayers pay 90 billion a year into the state pension system, and it's increasing. It means that the state pension system is almost bankrupt, if you will. And we think that there's a solution through capital market-based investments inside an insurance wrapper at low cost, and that should be our mission, to actually help these people. It is a very large market, and I think that would be that should be sufficient for us.
Yeah, Erik, stay niche, become everything to everyone?
Yes and no. We'll stay in the wealth management bucket. We'll offer more investment strategies. Yeah, so currently we have our own in-house developed quant value at risk strategy, if you want to simplify it. We'll offer more investment strategies in the future. However, we'll not start offering credit cards or loans. You see other startups branching out there, at least not for the foreseeable future, so not in the next 5 years, because that's a segment we're focused on, and I think, we are fast and agile, but focus is still super important. Yeah? I mean, it's hard enough to, within that narrow segment, stay ahead of the development, innovation, and tech curve. If we now offered 10 different solutions, that would result in a mediocre customer experience.
And so there's value in having more sophisticated products like quant, hedge fund, replica, those kind of products?
Yeah, I wouldn't call it more sophisticated. Yeah, we kind of started with a sophisticated model already, maybe even simpler models. One that is, I don't know, something like you offer, like super low cost, super plain vanilla, I don't know, classic Markowitz optimization, don't know, I've not closely looked at your product, something like that, then a strategy in between, then something environmentally friendly, then some, I don't know, smart beta. It doesn't have to be 10 strategies, but just maybe a variety of strategies. However, what's really important, and because some of you might ask, so when I look at these robo things and the different management strategies behind it, what's really different between doing that with the robo thing or just wrapping it in a fund? Yeah? I think the big difference is one is a product, one is a service. Yeah? And that really makes all the difference. And we see that with the banking partners that we work with. They have very similar strategies in a product format. We offer it in a service format. And the service format doesn't sell 10 or 20% better. It sells 10 to 20 times better, because people want a service, not a product. Because when you have a product, you have to make lots of decisions yourselves. What product? Where to select the broker, select the venue to trade it through, look at tax situations and all that. And usually, the majority of the people, they don't want that. A service that does everything for you, I think that's the way to go, and that's what what the robo business eventually is. Yeah, it's everything wrapped in a service. Our clients, to give an example, eventually they can just decide 2 things, nothing else: how much money they want to invest, and what risk class they want. And with that, we even help them. How suitable the risk class is, and nothing else. Nothing else. Turns out, for most people, that's much more attractive than trying to find out exact products and putting together a product selection.
So, Tamaz, I mean, one thing that he said, he would have just one of the portions in what he offers and exactly what your platform is. I mean, how do you compete with that when you can go to Scalable and get something similar there and plus more?
Yeah, I think so. We are more on Vanguard's way of thinking that actually on investing side, classical theory tells you Costs matter, and we are, from the beginning on, we're low cost, and we're very much more retail than a typical robo-advisor would be, because for them, actually, ticket size is very important, so that the services are starting at 10 or 20K. We launched at 2,000 euro minimum, and that's way too high. So we think to bring it to the masses, it must go really.
What's your average?
Our average is much lower than your average, so it's
how high is it?
15K.
Okay.
So it's.
And Erik, what's the average?
35 to 40K. Yeah.
So we launched actually where people do not typically launch, because we thought that's much more relevant for early investors or people who want to test. So that I think the value is the simplicity, because people, I agree with Erik that people just do not, like the less factors you give them, the less mistakes they make. The more factors you give, like 80% would say, oh, home bias, that's great, DAX company, single stock, give me this better strategy, which then makes no sense, but I've heard that tech is great, and tech is rightly valued and is a big portion of the passive. So the more dimensions you give, the more mistakes you make. So on the investing side, the value is in the simplicity and in the cost. That is what we deliver. I think that what is not in the market and would be great is a bit more take the investor's shoes and ask like how people decide. And people do not decide on the full portfolio. They decide on the liquidity bucket. They decide on the long-term capital build, and they decide on the mid-term fixed return. Because this is something which people also, German, if you give him a 5% for 5 years, you would be a billionaire. And people try to replace products completely in a not serious way with criminal intent. But if you deliver a product like that, that's something of a value. So we try to stay very, very simple in the buckets where we are. And to give a transparent experience. I also fully agree on funds. I mean, a fund wrapper, so when we launched, a couple of providers came to us, let's do a fund wrapper. Best way to make costs and transparent, and best way to actually not to show what you're delivering at the end. So actually, I think transparency and simplicity is core.
So I want to move away from this question of what your sort of offerings are, and because this is an ETF event, Roger, if we do get more retail investors buying ETFs through online management, what does that do to the ETF market itself? Will it have any sort of impact on what kinds of ETFs become popular and how they're traded?
What's the question?
So, for example, if we have everyone is getting their ETFs through myPension,
right?
What does that do to the ETF market itself?
Yeah, I think if I may interpret the question a bit more, what does it do to share ownership in Germany? And I think that is actually what is also binding us in the room today, that of course that we want Germans to invest more into shares. And that the ETF vehicles, as they're offered by various competitors, are a great way to make people comfortable about investing in shares. There is not a tradition of investing in shares in this country. People are still traumatized by Deutsche Telekom, which for 15 years now actually went once from 120 to 10. And I think that the whole ETF portfolio strategy, in which you have a very varied and spread out portfolio, is actually the way to do it. Shares comes with a manual, and the manual is actually the ETFs if you use them for long-term investing. And so the advent of ETFs is very much in line with also the model of today, something that will stimulate also share ownership in Germany. Now the interesting question, of course, is, it was said at another panel this morning, what also helps is a bull market. And shares have been performing very well the last few years. So the really exciting question or interesting question, of course, is what would a not so good market do with the business model that we all have, where ETFs are the core and where we, of course, all have an interest in getting Germans to move into share investing. And that will be very interesting, and they also play out the different philosophies that each of our companies have.
Erik, let me pose a question to you this way. If after this you're going to get coffee with Tim Buckley and you're going to prepare him for a world where everyone is buying their ETFs through Scalable Capital, what do investment in ETF providers have to change? How would they adapt to that world?
The ETF?
Exactly. ETF does the kind of ETF that is popular change?
Not necessarily. I mean, for us, ETFs are market access instruments. Yeah. So I think the question that you ask, Rogier, is the ETF market will become bigger, much bigger, because it is, if you currently look, how can a retail investor get an ETF portfolio? How can he? Yeah? Banks hardly ever advise you on it because they can't. Yeah? It's expensive infrastructure. With an expensive infrastructure, you have to sell expensive products. You can't sell cheap products with an expensive infrastructure with branches. So most people have to do them themselves. But doing that themselves is a very limited group of people. Yeah? I mean, who really wants to dig into and to do the ETF selection? So robo-advice is actually much closer to saving than investment, like doing investment themselves is to saving. So I think this whole robo movement you could almost describe as an ETF 2.0. It's a service constructed around ETFs. So the market will be much, much bigger. How will ETFs have to change? Pricing pressure, that's the obvious one. I don't think that fundamentally by construction they have to change. I once actually had an interesting discussion with my co-founder, yeah, that at a certain point in time, yeah, not in the next 5 years, but maybe later, maybe it doesn't need the ETF at all anymore. Why? Historically, you had economies of pooling, yeah, which gave investors an advantage. Now, through technologies, you can construct individual portfolios, one for you, one for your, I don't know, children, junior accounts are tax exempt in Germany, yeah? So I can use maybe even different ETFs for that. So individual portfolios. And if the cost of providing this individual portfolio through technology comes down so much, I can even cut out the fund wrapper, which is the ETF wrapper. Yeah? Will not happen in the next years because currently it's just much cheaper for us and our clients to do it through ETFs. But that's a thought that maybe I would like to place in your heads of how technology is not only or could disrupt the way products are sold. So now it's disrupting the bank advisors. Maybe it is also disrupting the whole concept of having a fund in the first place.
It's really interesting. I mean, do either of you two as well, have you ever thought about a world where you offer your services without ETFs?
Actually, Wealthfront does it, so they do physical replication for part of their portfolio. So I think that's not too far away, and that's I think that's a possible option, especially for the tax treatment in the US in that sense. I think what excites us is actually what excites our customers. I think Vanguard going much more into theme-based in the continental Europe would be one thing, which actually a couple of providers, including Xtrackers, are a bit retreating from for a reason. And the other thing is really simplifying further into target date funds. I completely agree that the simpler it is, the better it is. So ideally, you just input your age, and the right product comes out, which is the idea of that. So that I think those two directions would be a great next step for Vanguard in the market.
So we only have a few more minutes left, and I want to wrap up with, Rogier, something that you had mentioned, which is this interesting moment we're at in the markets. We have tweets from the US president sending markets into a frenzy. We have central banks tightening liquidity spigots, short-lived shocks, some of it very ETF related, as Tom talked about previously about the VIX ETFs. What are the role for online management services in this environment?
Well, we speak about share ownership, and the mission of our company and all of us three here is a lot about getting people also accustomed to long-term investment through the capital markets. Now, if this thing, and this is volatile, it is a fact of life that we from myPension tell people a little bit, well, you know, if you're long enough in it, this will catch itself. There's, of course, Scalable has a different approach in there, that there'll be some trading to take care of that. So, but what is common to all of us, of course, that we need to communicate with our clients and explain what is going on. I fully agree with Erik that it should be a service and not a product, and to be able to educate your clients that shares are a good thing, but that they may go down as well too, as long as in the long term they make the return that they need. That will be a challenge, and the test isn't there yet. We've seen a little bit, of course, on the Italy crisis, which was over before it really started. But if it really comes the way it was in 2008, we don't know how our clients will actually react. We'll tell them, are we still saying them stay put? guys, this is an opportunity to buy shares at a low, so be happy that you're not paying as much as you paid a year ago to buy them. I'm not so sure people will actually accept that, but that remains to be seen.
Yeah, Erik?
Yeah, I mean, most robos are long-only managers, yeah, so they will be affected. Bear markets are worse than bull markets, that's the obvious. You mentioned communication, I absolutely agree. So the communication piece is super important. When you think about robo, a lot of the focus is on digitally onboarding, so you don't need a branch, you do it via the internet, and then the quant asset allocation piece. What's super, super, super important is, we call it digital hand-holding. Yeah? And digital hand-holding means the advantage that a robo has, again, versus a product, just a fund, is the fund doesn't know its customers. The fund just knows it managed 600 million, 6 billion, whatever. It doesn't know its customers. We individually know every single customer. Yeah? Every single customer, down to the color of their eyes, because we have to take a scan of their passports. So I could just making up an example here. Yeah? Markets are down, and I can write you an email, dear Dani, your portfolio is down 6.1%. Main driver was, I don't know, US equities, but don't worry, this is completely normal. On average, it happens once every 8 years. The following steps have been taken, and so on and so forth. Yeah, I'm just like making this up now. And this is super, super, super important because, again, I mean, what do you compare it against? Yeah? A normal bank advisor cannot do that. He can't do that. Like, the markets are down, he has 100 clients, he doesn't even have the emails of the clients. Is he calling them? He's not even allowed to call them and give that specific detailed information. I think that's where one of the real advantages of a robo-advisor is. He has a direct mandate, he knows every customer individually, and he can do this digital hand-holding. Still, losses will occur, but that's, I think, how you have to tackle these markets.
Right. Great. Well, that's all the time we have, and it's a good note to end it on that perhaps if you invest in Scalable, they might know your eye color. It's an interesting fun fact. All right, thank you all so much.
We don't discriminate by eye color.
Dan, I don't know why I called her Dani Burger earlier, because she's actually on my show every single day, so I know her quite well. Dani Burger, they're the great panel. Just remembered also that I should probably plug my show. So if any of you are watching television in the morning, I encourage you to watch Bloomberg Television. I co-anchor the Market Open program every day from 8:30 to 10 European time. Obviously, if you're in Britain, it's an hour earlier. So definitely tune in. You can also just email me if you have any questions about the program or want to give us any input. We're very interactive, and if you have a Bloomberg, it's pretty easy to find me. We encourage you also to tweet about this conference if you like. The hashtag is Future of ETFs. And I think there's a Vanguard hashtag as well. Vanguard Europe, hashtag Vanguard Europe. It's been great having you all here. Thanks so much for joining us. We encourage you to network with your colleagues here, grab some lunch, and if you are in Zurich, come by next Thursday. We're doing it again. Thanks.